Hi, my name is Bjork, and we serve as the independent investment advisor for your organization's workplace retirement savings program. Today we're going to be talking about what's going on in the markets here in the first quarter of 2022, and we're going to do so through a piece called Student of the Markets. The goal for today is to provide educational resources to help you make the important decisions within your workplace retirement savings program and beyond. So with that, let's dive right in. So let's consider what we have on our plate so far here in 2022. We've got, the Fed just having raised rates. We got COVID still hanging around, midterm elections, sticky inflation, high valuations, geopolitical concerns, increase in market volatility. And so with that, I thought it would be helpful to take a break and let's look in the rearview mirror and let's consider the last 3 years. And so when we pull up the last 3 years, we can see that the last 3 years not only have been pretty great, but historically great. The 8th best 3-year period for US stocks in history. And so while, that's great news, this does tend to be a good news, bad news story. And what I mean by that is after each of these historically great 3-year periods, the next 3 years have never been as great. Now that doesn't mean that they were bad. If we look here, we see that 4 of them were positive, 4 of them were negative, 1 was pretty flat. But if you look at some of the dates here and scan through them, you can see the Great Depression, the bursting of the tech bubble. There's also some periods here in the 50s where we're coming off of really low interest rates and, out of the Great Depression, World War II. So when we look at the last 3 years, again, great 3-year run, but potentially a good time to recalibrate our expectations and revisit some strategies that may help us as an investor in this type of environment. So if we look, number one, at the current environment, let's talk about volatility. Volatility's been incredibly low for the last decade, with the exception of 2020, which had we all remember that violent whipsaw, the lockdown down and then the fast recovery back up. But if we look at the volatility chart here, we can see that the volatility tends to come in chunks over the last 20 years. So we've had a really muted period of volatility, and what we've seen so far year to date could suggest that there is the potential for an increase in volatility. So as an investor, talking about what we have on our plate in 2022 so far, the potential for increased volatility, what are some strategies that we can look at that have proven effective in periods in the past that shared some of these characteristics? So the first is staying the course. And so if we look at the case for staying the course amid volatility, let's look at the last 7 bear markets here and the subsequent 12 months. And you'll note here that while the ride was wild, the investors who stayed invested and stayed the course were later rewarded for that discipline versus those who sold at or near the bottom where they felt pain. Now, the second strategy that we can take a look at is diversification. And this is one of my favorite charts, and it speaks to the emotional challenge that a diversified portfolio can be for investors. So all we hear in the news and the financial media is how the S&P 500, or the market for a US-based investor, has been performing. And here we look at a traditional 60-40 diversified portfolio versus the S&P 500. There are environments here where a diversified portfolio just doesn't feel good. A great example is 2008, where a diversified portfolio lost 26.6%. Now that never feels good. And then coming out of it in the following bull market, the diversified portfolio trailed by 130%. So you left 130% on the table for being diversified versus the S&P 500. And there were many investors who questioned if the diversified portfolio was still relevant after enduring the longest economic expansion on record. So, it's easy to get complacent while you're being diversified. And in the last 2 years, we've seen a similar dynamic where in the first quarter of 2020, a diversified portfolio was down 23%, which again, never feels good. Now, the market's rallied since, up 119% off the lows, and a diversified portfolio has delivered just over half that. So it can feel tremendously frustrating for an investor who feels like they're either trailing or missing out on the markets. So on the surface, we trail, we lose money. We trail, we lose money. And the joke is that you probably know you have a well-diversified portfolio if it just doesn't feel good. Of course, the punchline here for those that scanned ahead is that over the last 20 20 years, the diversified portfolio actually beats the S&P 500 and does so with a whole lot less volatility and drama. So this is a reminder why we build diversified portfolios and how we can win more by losing less. And if we think about this 20-year stretch, we have the tech bubble, the great financial crisis, 9/11, the longest economic expansion on record. These were all incredible tailwinds for the S&P 500, and still the diversified portfolio, served investors incredibly well over that time period. So, what are our takeaways here? Well, let's think about where we started. It's been a great 3 years for stocks, but that's historically a good news, bad news story. The bad news is the next 3 years historically aren't quite as good. Inflation is grabbing a lot of headlines. Bacon, near and dear to my heart, is up 18%. We've had a historic tailwind for, as investors, but we're now facing a number of economic and geopolitical uncertainties with rising market volatility. This is a great time to revisit our workplace retirement savings portfolio, what we're doing in the plan and beyond, and to come up with a plan, to have a plan, and having that financial game plan, helping you be disciplined and sticking with it, is a great place to start. So as your plans advisor, our goal is to help provide educational resources like this, for you to, help build a foundation of investment knowledge, so that you can make, disciplined, well-informed decisions within your workplace retirement savings program and beyond. So we'll share some important disclosures to finish up, and just thank you all for your time and appreciate the opportunity to provide this content for you. Thanks. So long.